Greetings, Dr. Jeffrey Scott. This is my weekend market update for February 19th, 2023, although I'm recording it on the 18th. My email address is hgsidoc@gmail.com. If you're new to my channel, please subscribe and hit the alarm and you'll know when I post these. I post them whenever I do them, which is early or late in the weekend, depending on the weekend. If you have comments, you can email me. If you have things to put in the YouTube box, your remarks, I'll respond to them there as well. I respond to constructive criticism, both positive and negative, and I've adopted my videos because of some of that criticism. They're much shorter than they used to be. So I titled this one, Markets Pause to Refresh or Something Worse. This was an interesting week. Started off with a bang. I saw some major updates in my holdings. It was options expiration, so I actually sold off things and Thursday on the weakness. And then Friday, the market started off horrible. And then I'm watching one of my long-term accounts that is managed by a third party. And I just saw in the last 2 hours, it just skyrocketed and we saw a major recovery in the market. So even though it was a tumultuous week with CPIs and PPIs and Fed speak, and we'll talk about all this, the market really didn't do much. So are we starting to look like the Dow Jones Industrial and just going sideways and pausing to refresh? That could be the case. But obviously this is about risk management, and I also have to be concerned, is it possible it's something worse? As always, it's for educational purposes only, and anything I recommend is in the spirit of education, not investment advice. I am a doctor, not a broker. I am not affiliated with any software vendor or trading company. My tools are found in a number of programs, including Wealthcharts, and the tools that I use are tools that I pay for. Trading involves risk. You are solely responsible for any investment decisions you make. For those that like this video and want a 5 to 10 minute version of it during the week, when I have time, I post these. I usually do them late the night before, and the Wealthcharts team posts them at stocksanddocs.com sometime early on the morning of the trading day. Major markets tell us a story, and there's a big story here. So let's look at a couple of things. We'll start with what's in yellow are the major indices. This first column will show you that of the major indices led by Russell and NASDAQ once again. And I think what we're seeing is recovery, frankly, in some of the beaten up small cap, high growth tech stocks. The laggards, well, the Dow, NYSE and spiders, but they're only down a little bit. So as I said, a week that was felt very volatile, and a Friday that was extremely volatile. The markets ended up kind of doing not much. Now, other cool things. Notice that all the major indices are no longer down 20% from their 52-week high. Now, since we haven't lapped the 52-week highs yet, it's not because the highs fell off. So we're now closed below 20% down. And if we look over here, you could see in yellow how much we're up from the 52-week lows. And we're almost approaching a new bull market on the NYSE. And you could see the 52-week lows were set on October 13th. Now, the other thing to see here, ARK Innovation, those small cap growth stocks are actually up 6.9 on the week. Bitcoin up 14.3, and look at how ARK and Bitcoin have come off their lows. So clearly there is a rotation back to those beaten up growth stocks, and I think we see it in the ARKK. On the industry groups, in green are the ones that were positive on the week, and it seemed kind of funny to see both staples and discretionary there, but I think the story is how the week ended. That discretionary had a big bump because of retail sales. I mean, look at things like Abercrombie and Fitch. I mean, what recession's coming? What impact on the economy do we have? Who cares about rates? The stock has done amazing. But look at what happened on Friday. Friday, staples were up 1.3, which is their entire gain for the week came on Friday. Utilities were up 1.1. The entire gain came on Friday. And discretionary was flat. So it's almost as if even within the week we had a rotation clearly out of energy. As you could see, energy was down 6%. But as the week went on, into a more defensive posture. This is something that Sager does in Q. A lot of it, well, some of this was modeled after what I do. The buckets, and we'll talk about that when I get to the edge rater slide, but we're looking for a preponderance of stocks either below or above to give us a signal. We're looking at the pie chart here, which is how many stocks in the S&P 1500 are above or below their midline, to see if there's a shift or a over too much to one direction, overbought or oversold. We're at neutral. Down here it tells an interesting story. Let's look at short, intermediate, and long. Intermediate, 5 days. Sectors mostly up, industry groups mostly up, and stocks 62% were up. So over the week, that's why your portfolios didn't have much of a problem this week, and maybe finished up despite some of the craziness. But if we look at 2 weeks, 91% of the sectors are down, 77 industry down, 68 of the stocks are down. And if we just look at the last 2 days, you could see mostly down. So Friday was a 50-50 day, a neutral day. Over the week was a positive day. But looking at a 2-week period, obviously the prior week was down a lot, which is why the pie charts look that way. Underneath, I care about interest rates. Well, rates on both the 10-year and the 30-year kind of spiked this week, and I'll be watching those closely, and so will the Fed, which has to digest a hot CPI, PPI, retail sales, employment, and others. Do we have a recession coming? I remain in the recession camp. I am evidence-based, and I look at the data. Now, of course, the data can always not be predictive as we might hope it is. But if we look at the 10-3 yield curve inversion, here's the zero line. The gray bars represent a recession. Going back to 2000, every time that we've traded below the zero line, it's followed by a recession. The other thing to point out, the recession occurs when the inversion goes away. How do you get the inversion to go away? You start cutting short-term rates. When do you cut short-term rates? When the Fed is worried about the economy and wants to start stimulating. Okay. How about the credit spread, measurement of credit risk? We are still elevated off of where we were during 2017 up into the late 2018 when it spiked and the market sold off. We are below where it was in the quiet areas of 2014 and 15. Now we've come off the highs, but often this predicts a future recession as credit gets tight. We'll see where that goes. And then something that might be analogous to the PMI, the Philadelphia 3rd District Diffusion Index. And notice like clockwork, when you drop below the zero line, you get a recession. Now, the thing that I will also recognize is you can get drops down to the minus 20 and no recession followed them. We're beyond minus 20. So 3 pieces of information that have me concerned that we might have a recession in our near future. Now, short-term breadth, stocks above the 200, stocks above the 40 eased off their highs. And the one that I find most important to me, the T2121, which is the 12-week new high, new low ratio, 13-week new high, new low ratio, came off. And this thing is like clockwork. When you get to the top, the markets at least turn down for a short period of time. Now, they can also go sideways, and then you have what we had this week where you might have some rotation underneath. The buckets, again, mentioned this before. This is a measurement of how extended stocks are. It uses the S&P 1500, which combines the large cap 500, the mid cap 400, and the small cap 600, and asks the question, if you put a Bollinger Band on every stock in those indices, where does the stock price close? Now, percent B of 0.5 is the middle of the Bollinger Bands. In green would be the stocks above the middle, red below, and that's kind of a tie. And then I look to see how many are above the bands, how many are lower than the bands, and this is very neutral. So the buckets don't tell me anything. Now, the Hindenburg omen is not going to fire till we get to new highs again, but notice during the 2022 era, the number of new lows on the NASDAQ greater than 2% was every day. Number of new lows on the NYSE, not as much. Notice on the NASDAQ, we did see new highs off of the October lows, but we still saw the new lows. Notice here, almost all new highs, and when you look at the NYSE, all new highs. If this market was on the verge of a major correction, one might expect those new lows to start perking up before the market rolls over. So I'm watching for that. It hasn't happened yet. So is this still a junk off the bottom rally? I think so. This is a warehouse report where I take a file which has all the market, and the file is from 212, so last week. So the market closed on 210. And then I run a number of analysis forward on that data to see how it predicted outcome. Well, ERG is a combination of EPS rank, relative strength rank, and group rank, things that would be familiar to those that are investors.com, can't slip IBD fans. And the interesting thing here is almost all stocks are above zero, which means there was a lot of positive performance this week. I throw out the head and the tail because you can see down here there's just not very many stocks. And what you see again is that the low ERG stocks are the ones that are leading. So we're getting that quote junk off the bottom. Now, if you look at relative strength, it's the worst relative strength stocks that are leading. So if your whole methodology of trading is to find the highest relative strength stocks and buy them, probably not doing awesome right now. That will change. So is this rally just junk and low quality stocks? I think that's part of it, but I also think it's a lot of these Rokus and Zooms and other small cap growth stocks that got pummeled in 2022. I always like to talk about your news and earnings dates because these are critical, and we've got another good week this week for news. We've got nothing on Monday because it's a market holiday. On Tuesday, we get the PMI. On Wednesday, you get the FOMC minutes. On Thursday, more jobless claims and a GDP revision. Notice we have Fed head speaking after the minutes, not Fed head, but Fed president. And then the PCE, which we know is something that the Fed watches closely. So we got a big week again, and we saw how the news drives the market all over the place. One thing that you gotta like is what happened on Friday when, because of concerns on some economic numbers, as well as late on Thursday afternoon, I think maybe not late, 12:30, 1 o'clock, Fed President Bostic, who I guess is speaking again this week, said that maybe we need a half a point at the next meeting, not 25 basis points. So the market held up Friday at the end, pretty remarkable compared to how it opened. If we look at earnings, you could see we got a lot of earnings, and there's big names here: Walmart and Home Depot, Techinco, one of my favorite on the miner side. There's some energy like Diamondback, FANG, one of these great tickers. How about Nvidia, Moderna? Quite a few things to watch this week. As I say in the lower right-hand corner, it's a judgment call to hold stocks over earnings date. It's just bad judgment to not know when your stock's earnings date is scheduled. Market thoughts: we survived the gauntlet of news. I think this is going to pressure the Fed on rates, and my guess is it will pressure them potentially to use the word higher or longer again, and we'll continue to hear from Fed speakers. Showed you minimal moves on the large caps, a little bit up on the small caps. Sector rotation, strength in defensive names, energy sold off, especially during the week, end of the week. We have a Monday market holiday, but as I showed you the news and the earnings, there's still plenty of opportunity for volatility. The rally still is intact but under pressure, and I'll continue to closely watch two things that are important to me, the US dollar and 10-year rates as clues to direction. If these things start to come down, my conviction to the upside will be enhanced. However, a break of my line in the sand on the USD and a break at 10 years above 4, I think you got to be prepared for the next leg down. I did raise some cash going into Thursday and Friday, still have long positions, but there are trades that I can take that to me are lower risk. Spreads instead of single options, which reduce my cost of getting in, although they will obviously limit my gain as well. And then doing some what I call unbalanced, it might be the same as broken wing butterflies, where I design a butterfly. The benefit of a butterfly, you're buying an at the money call, you're selling two out of the money calls, and then you're buying a wire out of the month call to protect you on your short extra call from the two calls that you buy in the middle. The benefit of a butterfly, a standard butterfly, is it's a low cost trade. Why? Because the upside is limited, and if you trade above the out of the money long call, then you basically lose on that trade because the butterfly becomes worthless and you paid for that butterfly. So the person selling the butterfly has very limited long upside risk. So they're cheap. But what I do is I extend out one of the legs, so even if the stock blows right through the out of the money call, there's still a positive return on my trade. Something we could talk about at a different time. Why are those low risk? Because by spreading out the cost of the trade, I'm lowering my cost to play, and it's defined risk, which is the cost of the option. And I have, any risk I have is what I paid for the premium. Now, this is the happy slide. And this goes out to all my friends and followers who are just, man, this has been a tough market. Yeah, it's kind of been a tough market, but it's, people made money in this market. And especially since the beginning of the year, it's felt like a different market. The purpose of this slide is to remind us that after a bear market bottom, we can go back to 49, you get massive returns over the next 12 months. Question always is, when is the bear market bottom? Right now we're looking at October 13th, 2022 as the bear market bottom. It's hard to get into the market on the lowest day, but if you look here at March 9th, which was the bottom of the 7, 8, 9 debacle, the market actually bottomed earlier, but that's when folks started considering that market decline was over. So let's hope we get one of these big double-digit returns. But the key and why money management, cash management is so important, you got to have cash left in your account to take advantage of it. All right, so we're going to look at Wealthcharts today. Let me actually open. I think I got to load my Tasty. I made a comment on one of my nightly ones. I always call Tastyworks Tasty Trade because wouldn't you think the brokerage would be Tasty Trade? Well, apparently they've actually are in the process of changing the name. So I start here with the flames. I'm looking at things that started moving up, and the flames said they moved up a lot, but I also see they're in the 400s, so they've moved up a lot, but their relative strength is still low. But XPH Pharmaceuticals, XLP Staples, and XLV Healthcare all got flames, which means they all had a pretty big move over the last couple of days. But like I said, they're still low on the Wells score or the relative strength. Let's look at the indices, and let's start by looking at the S&P and talk about what I saw in the markets. Now, Friday I actually worked from home, which is unusual. Didn't do much intraday trading, but I did trade a little bit when I saw the intraday reversal. So here was if you want to find typically where the day ended, look for the big volume bar. Here's the last candle on Thursday. And remember, Thursday, gap down, fought their way back to get close to where it started, double topped, and then rolled over. And then as Friday came, we continued that with another gap down, and then a sideways move, and then sometime around 2 o'clock, the markets took off and closed above where they gapped down to in the morning. And we'll see, as we mentioned already, NASDAQ and Russell actually got to positive. So I like to see reversals to the upside, and we did see one on the S&P. When I look at the daily, and then this is where it starts to be a question of what's going on here. This was the mother of all trend line resistance, going all the way back to January 4th of 2022. 1, 2, 3, 4, 5 failures, and then later in the 5th attempt, we broke through it. Haven't retested it except maybe 2 days later. I drew this line off here, but we've now violated that line. But one could argue, one could make the argument that what we're seeing here, and we could probably make the same argument across the board, and I'm just going to build it on the spiders. But are we actually seeing here a bull flag? If we are, we'd expect an up move this week, at least into the Fed report. A breakout above this would be bullish. Here's the flagpole. Here's the flag. So it's hard to be really bearish here. We have not broken the 50 or the 200. We have not broken this trend line, which if I extended it down to here. So technically, what changed for the downside? The MACD is rolled over. That's one thing that changed. All right, let's look at some of the other indices. I would say that we have a similar pattern with a flag potentially, or a wedge, bullish wedge, whatever you want to call it on the Qs. I mentioned, are we starting to look like the diamonds? So the diamonds are interesting in that they broke out way before the others did. And all they're doing is going sideways here. But is there anything wrong with this chart? We're going sideways above the 50-day moving average. And I don't think I see a close below the 50 since January 25th. That's a healthy consolidation, in my opinion. The Russell has held above this line. Again, similar flag and a breakout. So none of those are particularly bearish. They're just orderly pullbacks and consolidations. You'd expect the VIX to go up if the market was going to roll over. Here we're looking at the VXX. It's up, it's down a teeny bit. And I know a lot of people are starting to look again at the UVXY. And if we look at that, we could see the UVXY was up 0.79%, but the red candle says it closed lower than it opened. Now, what's the line in the sand and why am I concerned about it? I think the dollar is critical. So if we look as this market was selling off, the dollar got stronger. It ran into this point here, $28 and a dime, 13 cents, and it failed. It ran up here again and it failed. So we had a double top. We ran back here. We struggled at it for 2 days and we broke above it. Came back and retested and ran up significantly. So now the question is, are we going to find resistance here? We've found it for 3 days in a row. We break above, but it's where we close that matters. And if we break above, then the 200 becomes the test, and then do we race against old highs? I think if you want to see this market go bad, one of the drivers is going to be or could be the US dollar. So the US dollar had a reversal on Friday to the downside after trading up, and gold and silver also had reversals to the upside after trading down. Now, on the weekly gold, make sure I highlight the right one. I mean, it's sitting at a place that if it's going to bounce, you would think this is the area that it's going to bounce. But I think it too is held hostage by what the dollar did. Oil and energy stocks, which last week were starting to look interesting, just hit a wall this week. And oil's at best going sideways. And natural gas continues to do nothing, down 6%. The second factor, besides the dollar, that I think is going to be critical is this thing here. Now, that was actually a nice candle for the bulls on Friday as we had a reversal. And that could signal a top. Now, if we've got a top in the dollar failing at that resistance, if we see a top here, let's just put a line on here. If we see a top here, which you could argue is pretty close to a double top on the 10-year, if both of these roll over, the dollar and the 10-year, then this market's going to rally. The market certainly feels like it wants to rally, but the thing that can stop it, I think, is going to be pressure on the Fed to talk more hawkish. Weekly market timing, we know it's going to be positive because it's a weekly bar, and on the week things were flat to up. And you could see the spider, the Qs, the IWM, and the diamonds are all above the 30-week WMA. Notice the doji formation on the diamonds. The Qs kind of on the spiders, and the weekly bond goes green. All I could say is that my timing model is bullish, and the only reason I've got conviction issues are those dollars and the 10 years, and that could get better really quick. If we look at the sectors, early in the week, it looked like technology was going to lead and discretionary, and at the end of the week, they weakened. So where's the strength right now? Well, look at the staples. Well, industrials isn't a staple, but it's probably less speculative than discretionary technology. Staples, utilities, and healthcare. Look how materials have sold off. Energy is sputtering here, not giving us a great, communications is sputtering, energy is sold off. Now, if we go into my bull scanners, and even though I'm worried about the market, I don't see a bearish market here, and I've got to play the market that I see. So I'm going to look to the bullish side. So a lot of things that we can do. We can look at the heat map and get a sense of how the market closed on Friday. Interesting. The indexes got better, but on the large cap stocks, Tesla really paved the way, up 4.5% or 4%. Meta was up less than 1%, but a lot of red. Okay. What about technology stocks? Also a lot of red. What about the Russell 2000? Small cap. A mixture. So I wonder how much of the positivity on Friday was related to Tesla. Tesla had a traded down early, but ended up trading up 3%. Remember, Friday was options expiration. I think they like to get us to sell our options, and then they take the price right up. On sector scanner, let's just look at the algo score, the strength being industrials. We talked about that. Interesting. Cyclicals. Let's look at the weekly algo. Financials. Yeah, it's interesting. There's been so much rotation. The further out we get, the more confusing I find it. But you could always do your top-down review by starting in the sectors, and let's just look at one. We'll look at industrials because that was pretty much uniformly something that was positive. Let's look at industrials and compare it. And then let's look at the different groups inside industrials, and let's take like the first 10 or so, and let's compare and get their stocks, and let's take the first bunch of these down to maybe 650. Now let's see what our default watch list is, and let's change it to my weekend review. Apply, and then let's just add these stocks that I checked. Whoops, I didn't check anything, did I? I thought I did. Let's try this again. I think I did, but I can't remember. So I'm going to come down to here and add to watch list. So you could build your weekend watch list by adding stocks from your favorite industry groups or sectors. You can look at Wealth Scanner. So Wealth Scanner, I'm looking at my top-down indices, which is a series of ETFs for sectors, indexes, etc. The first thing that comes out and smacks me in the face is how low these scores are. And that's not good, because if the market is going up a lot, you would expect the 600 to be a medium score and see a lot of things in the 700s and 800s. So no surprise the Russell is leading here. Euro stocks, they did well with the weak dollar, and frankly the US seems to be lagging. Insurance, industrial, ARC robots, aerospace, retail. Okay, I'm bothered by that. If I look at the bearish scanner out of curiosity, and the bearish only goes up, I think, in the 600s. It doesn't get to minus 800. So it's not big numbers. Natural gas, which has been weak. Here's the problem with energy. Look at this. UNG, XOP, TAN, and commodities in general, USO down here, all had a weak couple of sessions. Let's just look at TAN. This is a tough one because you could see on the weekly chart especially. We used to have these meetings in Palos Verdes, and we'd have to tell Ian whether a stock or an industry group was loose or tight. And the tighter you are, the better you do, and these things are all over the place. So that's not good. So I don't see a ton of strength to the downside or the upside. Let's go back to the bull scanners. Let's go to my CAT scanner. Let's pull up that weekend review. So the weekend review will have the stocks we just dumped into it, plus anything that I put together prior to doing this that I throw in there as part of my workup for the weekend. Now, I've got this set so only things with recent reversals are going to come up to the top. And these are my weekly buy list. I didn't ask for that. I asked my weekend review. There'll be more stocks on that one. There we go. So look at how many 4s and 3s we have. That's powerful. It tells me there's some strength in this market. Arbor Realty pays a dividend, among other things. But look at this. Massive volume, 4 green dots, so gap on volume, breakout momentum. All daily and weekly bongo have turned green. Relative strength and OBV are flying, and it's broke its 50 on the weekly as well. ABR, John Deere. Now I'm going to talk a little bit about John Deere because this is one I'm interested in. Got great fundamentals. Ag space, especially the vehicle space, has been doing well. Earnings are out. Look at the volume. Again, 4 dots. Relative strength and OBV going crazy. High jump bar at 49.2 tells me it's not extended. So I just want to give you a clue as to how I look at these, because with scanners, you'll find what happens on Monday is more. I might find the stocks that look the best to me from Friday. But what happens on Monday is probably more dependent on the market than on my stock picking prowess. So what we really want to do is get a sense of what the market is doing. And if I was to put buy stops in on something because I go to work, I want to make sure I don't get filled if the market rolls over. So here's how I usually look at something like this. This is just for me. It's not necessarily how you have to trade, but I like talking about this because just because I say it looks good on Saturday, I have no idea how the market is going to look on Tuesday morning. There could be something related to a war or something bad. So there's no way one can predict exactly what they're going to do. But if I am thinking that I might want to be long John Deere, so here's how I might look at John Deere. Long Deere. So I want to know the close. I want to know the high, the low. Where's my stop? And my stop is either lowest 4 bars or natural place. I'll talk about that when I get there. And my buy stop is typically above the high. And I'm willing to risk up to, say, 8%. All right, so now I'm going to go back to this, and I'm going to call up the data. And make sure we're on the right date. So now I'm going to go pull back up my little note. So closed at 433.31. Its high was 436.38. The low was 415.50. So you might be able to see already the problem with a stock like this is there's $21 between the high and the low. But $21 on a $400 stock is only about 5%, so I can live with that. So now I want to know what's the lowest bar in the last 4. Well, that's going to be this one. And the lowest low in the last 4 is 402.83. So we'll put that in here. And my natural place, I'm looking at this stock, and part of the reason why I would have taken the trade was it broke out of the 17 and the 50. Again, education only. I'm not saying I'm taking the trade. All right. So I could say a natural spot is if it broke below the 17, then my breakout has failed. And what's the 17 at? 413.35. So let me put that in here. Now, my buy stop is above the high, so I would put a buy stop if I took this trade at, say, 436.45. Now, people would say, well, why would you do that? The stock's going to have to trade up $3. Okay, that's not even 1%. Why? Because if the market opens down, I don't want to get filled and then have the stock plummet. I want to be filled if the stock has momentum to the upside. And often after an earnings-driven big move, stock takes a rest. So if the stock takes a rest, why do I want to be in the stock? I might get a better opportunity. So if I'm looking at, let's say I'm going to take this stop right here, 413.35. I'll put it a dime below that, 413.25. So I've got about $20 there. I'm risking here 4 to 5%. That's good. I like that number. So I would basically go to my trading platform. I would put in a conditional order that says if John Deere crosses above or hits my buy stop, then I am going to buy X. Now I'll spend more time over the weekend, decide if X is a call, is it a vertical, is it a butterfly, is it a synthetic, or is it shares? On a $436 stock, probably not going to be shares. Then I've got to ask myself, what is my target? Now, this has been a tough market. Things are failing quickly. So what I typically would do in this market, target, I'll go T1 and a T2 and just talk about what I do. I would probably put at least 5%, a little bit more for target 1. And when I hit it, I'd probably close part of the position and raise my stop to break even. If I get more conviction to the upside, I might go twice my risk, 2R. So T1 is going to be my first stop, and I've got that predetermined. I take off half, and I raise my stop to break even. At my next target, which I'll define, probably twice what the first target is from a distance, I will raise my stop again and probably put in some type of a trailing stop. And then I may or may not take off more of my premium. But what I want to do is then let it run and let the stop do its work and take it out. By doing a trailing stop, the stop will follow the price up. So the key message here is, and again, this is pure education, I'm not recommending John Deere, is I like a buy stop above the high of the day personally because it forces the stock to move in my direction. And if the market is going to do horrible and I'm unable to take my order off, I'm likely not to get filled. If the market opens down 400 points and John Deere opens up at 405, I certainly don't want to have a buy stop in that gets filled. All right. I've defined what my risk is on day one with once my conditional order is filled, my stop is applied. I've got my initial target and I have a management plan of what I'm going to do with that stop and my position size based upon hitting the various targets. That's my trading plan. I hope you all have your own trading plan. So a lot of times these stocks that break out, and I've been a breakout trader for a long time, a lot of time when these stocks break out, they fail, and you don't want to be putting stop. In my mind, if you put your buy stop below, you'll get filled on the way down. And if you put a market order, you'll get filled higher than the stock trades the rest of the day. I'd rather put in a limit order above the price and require it come to me. That's how I trade. Doesn't mean how you have to trade. A lot of people are talking about Hubs. Hubs is one of these application software tools, I believe. And these things had a big run in the last market. So you could see right here at last bull, highs of 863. It's now over half off. It had a gap up. It doesn't have the fourth dot because it closed at the lower part here. On big volume, relative strength and OBV look good. Hubs looks interesting. There's a lot of interesting stocks here. Pediatrics Medical Group. Here's one that had a big move. I don't like the 200 days sitting overhead. I probably would pass. DraftKings. They're talking about becoming profitable next year. Again, from the mid-60s down to the teens. Is this junk off the bottom? Well, this is what's working and I think driving the ERG for the lower ERG stocks. But here's a stock that gapped up, had a wealth signal, it had EMS the day before on massive volume. Look at relative strength at OBV. I don't consider it extended. The 50 is still below the 200. OEC, don't know this one. Does it have enough volume for me? Look at that. Now, I want to reiterate that by putting in the daily bar since and then defining that I want daily bongos and weekly bongos, I'm only showing stocks that have had a recent reversal on the daily. This is a reversal with the bongo going red and have maintained a weekly that's green. Don't know anything about OEC, but what a beautiful looking chart. Gapped up, volume, breakout, momentum, great relative strength, and OBV. AMCX, not movie theaters, but the TV channel or I think we're at a point now where content matters. AMCX has content. They have streaming services, potentially acquisition candidate, and look what happened when they had blowout earnings. Massive gap up on great volume. The breakout was the day before with momentum. Look at relative strength and OBV. And again, I don't consider it extended despite the high jump. It's still just crossing over a descending 200-day. Gotta like that. You notice how just by running the scan, OIS, you get the same stock over and over again. Breakout on volume with momentum, strong relative strength, and OBV. Now, we saw that healthcare was starting to move, so maybe there's some early opportunities in healthcare. So I might go through here and look at the healthcare sector. And this is that pediatrics, so we're not going to look at that. I want drugs and biotech and pharma. So Ironwood, they actually have products on the market. Don't know much about them, but I like the pattern. They go sideways and then they break out here on volume, momentum, relative strength, and OBV. Mankind used to be a questionable company. They named after the founder, and they had an inhaled insulin. He's out of the company, but what a beautiful chart. Broke out here, coming out of a squeeze. Kind of the signals that we like to see back here. Pull back in here, had another breakout off the 50, and now it's running again. Still a cheap stock. I like that pattern. Retta is another pattern I like a lot. Don't know anything about it, but you could see it's in an uptrend. It had a pullback, and now in massive volume breakout above the 17 with relative strength and OBV. Cytokinetics is another one that's been an interesting story. Sold off here, broke above moving averages, momentum, breakout, good relative strength and OBV. There's a lot to like in this market. Now, if we go and look at the short side, let's just run the CAT scanner on my short review. And let's see what's got 4 red dots. Nothing. AMN. So you can go through this and find stocks that look weak. So AMN is sort of a shooting star. New lows on volume, momentum, breakdown, relative strength, and OBV dropping. Weak as well on the weekly chart. AR. Energy got hammered this week after looking so good last weekend. And you could see an EMS signal, volume, 3 dots, and a breakdown of relative strength and OV. BioNTech, one of the vaccine companies. Moderna said that Americans aren't going to have to pay for the vaccine. I don't know how that's a business model. They have earnings this week, so maybe they'll explain. Coming out of a squeeze goes both ways. Failed at the 17. Volume, breakdown, momentum, relative strength and OBV falling. I mentioned energy's weak. How about FANG? Again, one of my favorite names, but not my favorite pattern. It broke down above the 200. It's probably going to go down, at least revisit here. Could drop further. And when I see these, every one of these energy names being weak, you wonder what the fundamental story was. Was it just oil was down? Is it the strong dollar? Is it because the war in Ukraine ended? No. But it's fell so much this week, the XLE, that maybe we should be careful shorting these energy stocks. Here's Gush, which is a S&P oil and gas. I'm not sure if this is the underlying explorers or the services, but you could see a breakdown here on massive volume. In fact, Sitting right here is the XLE. And the XLE broke down from the 50. One might expect it to come down just about 2 or 3% more and retest at the 200. Now last week I talked about if you feel the markets are going to roll over, one way to play them to the long side is contra ETFs. These go up when the markets go down. I pointed out that these are not investment vehicles, and they're not. Um, with this week, the market's doing nothing, meaning the biggest up was a little bit over 1%, the Russell, and the biggest down was less than 0.3 or 4%. Contra ETFs would not have been good trades. But keep in mind that if we do get a massive sell-off, these are ways to play it. For example, Dust, which is the Contra ETF, leveraged 2-to-1 to GLD, or to gold miners rather, which might be GDX. And notice how it ran up as, let's just add a new chart, duplicate. Let's make that GDX. So you can see that we're going to change that from GDX to Dust. There we go. So as GDX is dropping, Dust is going up. So GDX falls. The opposite, which will go up 2-to-1, is Dust. So be careful with these. As I said before, they're not great investment vehicles. They're great trading vehicles. So let's just rehash. This went longer than I like, probably longer than you like. I think the markets are still going higher. I think if someone told me that we're going to sell off after the Fed minutes come out, I believe them. I think the rest of the week becomes dangerous, especially with the PCE coming in on Friday. But like last week, it doesn't mean we have to crater. My indexes, my indicators are still saying we're in buys. And as I've said before, sometimes my conviction is lower. My conviction's lower until we settle out through this news. Have an awesome week, and we'll see you here next week.